So in this video, we're going to start Unit 9 about stabilization policies. And this unit might be a little bit misnamed. It's really more about long-run stabilization implications because we've already learned about monetary and fiscal policy in this unit. So instead, this is more like what happens in the long run and what are some considerations of the different policies that we've learned about fiscal and about monetary policy. So this first lecture is more, here's some big things to consider, things to know when you, the important policymaker, have gone off to play with the levers of fiscal policy or monetary policy. Hey, these are things to know about. So first off, before we forget, we've got really two kinds of fiscal policy. You've got the taxes and transfers kind, where you're changing how much people are taxed or how much Social Security they get and those sorts of things. And you've got the government spending kind, right? The dollars on, military spending and schools and that sort of thing. And we have some issues actually that we've already talked about from Unit 7. And this is a good time to maybe quickly review them. They're the downsides, right, or the things that you have to know about that may not make fiscal policy as effective. So reasons not as effective, reasons it's not as effective. Notice that I'm not saying it's ineffective, it's just reasons maybe they aren't as effective as you might think. And the first would be is that there's lags, and we actually talked about three kinds. There's three types of lags. The first kind is to think about identifying the problem. The second kind is developing the response, and the third kind is implementing the response. And it takes time to do all three of those. The second issue with fiscal policy is that politicians sometimes are motivated to increase AD when it's not warranted, when they shouldn't, right? When it's unwarranted. When you're not in a recession, but you want to get reelected, maybe you cut taxes or maybe you increase government spending. The third and fourth issues are actually reasons why AD doesn't go up as much, why AD doesn't increase as much as we would think when we do taxes, transfers, and government spending changes as much. And these are to say, first, when you have typically higher government spending or lower taxes, you have to borrow, and that reduces investment spending because of higher interest rates. And we call that the crowding out effect in a previous unit. The other thing is and this is one that we're going to examine in Unit 10 as well, that when government spending rises, the price levels rise. Or when we cut taxes, price levels will rise. And that's going to reduce how much we export to other countries because our goods are more expensive. So let me kind of write a shorthand here. If we say taxes down or government spending up, we'd say therefore aggregate demand goes up, which is what we want, but therefore price levels go up, and therefore XN actually goes down. And so that has the effect of reducing aggregate demand. Now, this reduction is not the same magnitude as the initial increase in aggregate demand, but it's to say that, if you increase government spending or you cut taxes and you expect to get more output, you're not going to get quite as much as you would think because of the lower net exports. Now, there's two other questions that come up usually in this unit that are in the long run of using fiscal policy, and they're the impacts of debt and deficits. And the first question is, should persistently large deficits occur every year? And most economists are going to say probably not. That there are some economists who would say that, it depends on what we mean by large and persistently large, but we would probably agree that especially during economic expansions, it's not typically a good thing to be running very large deficits for two reasons. One is the possibility of crowding out, although there's lots of research indicating that maybe that's not as true as we might think. And then the second is the high opportunity cost of paying interest on the debt. Now, this one also is not such a big deal if the interest on the debt is relatively low. If lots of countries trust us, then it's not a big deal. But if you're running a country where the interest rates are high, then you're giving up a lot by spending all that interest. You're not spending it on things that you might care about. So those are two considerations, although kind of mixed messages from a lot of economists. The second question is, when's the national debt or deficit too large? And I've given you here two. These are not hard and fast numbers, 3% and 1%, debt to GDP and deficit to GDP ratio. And what that means is you basically compare what's the size of the public debt to the size of the national economic output in a year. And so it's like saying, if a household earns $200,000 a year, it wouldn't be unreasonable for them to have $200,000 in debt. But if they earned only $20,000 a year and they were $200,000 $100,000 in debt, that would be a problem. And the earnings would be like national income, like GDP. So we would generally say that more than 100%, if the debt is, say, 5 times larger than the GDP of the country, that's 500%. That's a bad thing. So I wanted to show you, here's a graph from Fred, the federal debt, total public debt as a percent of GDP. And you can see here that in the decades of the 1960s, it was ticking downwards from 40 down to about 30%. And at the beginning of the 1980s, it was about 30%. And then we start to see persistently large deficits making the debt rise. So again, this is debt. This is the total, right? The total owed. And that's to say this amount is how much owed as a percent of GDP. And we saw GDP rising during these years, but not as quickly as the debt. And then starting in the 1990s, it actually started to drop again. And that's because we actually started to see deficits becoming surpluses. The government was taking in more revenue than it was spending. And then we kind of bounced around about 60% until the 2008 recession, when GDP went down a lot and debt went up a lot. And so we saw the percentage top 100%. And since then, it's been right around 100 to 105%. And there are some economists who say, oh, don't worry about it, you could go way higher than that. There are some developed countries that are way higher than that would be, way up here, 200%. But generally speaking, we would like this number maybe to be a little bit lower. For the other consideration was deficit to GDP ratio, and that's really just on an annual basis. What's the relationship kind of look like in terms of that? And let me grab the graph here to show you that really quick. Basically, we're looking at here the surplus or deficit as a percentage of the GDP. So if it's a positive number, that means that we actually had a surplus that year. And we can see that since the 1920s, we've only had a few years of surpluses. And actually, since World War II, we've only had really one sustained period of surpluses. The general rule of thumb is ideally 3% is your deficit to GDP ratio. And you can see that for most of the post-war period, right, World War II here, most of the post-war period, we actually stuck with about 3%. And then it actually started to get better here with those deficits, and then went back to about 3% right in there. And then the 2008 recession. Now, a really nasty recession like this is not unusual for the deficit to GDP ratio to go down like that, because you're borrowing lots, so deficit would be rising at the same time GDP is falling. So this recession was nasty, and that's really what's happening here as well, is why we dropped so much and we borrowed so much during World War II. But we can see this is a disconcerting trend for it to be going this direction, especially since roughly 2013, when the economy was doing really very well. In the last several years, the U.S. government has been borrowing a lot of money as a percentage of GDP, and it's crossed that 5% threshold, and that's a little bit concerning maybe in terms of we're in a good economic time period, at least as I speak, and so maybe we would want that to be a little bit more closer to the zero line. So those are some considerations that we have with using fiscal policy. Let's talk about monetary policy, because it's not perfect either. Remember, monetary policy has 3 tools. You have the reserve requirement, you have the discount rate, and you have open market operations, which are buying and selling bonds. Now, these 3 tools, we know that this one is the buying and selling bonds is the one that they typically use to target a lower federal funds rate or a higher one. But there's some issues. The first is some central bankers have a temptation to pay the national debt by creating money. And this would be true if you don't have an independent central bank. And that's called monetizing the debt. Basically, the Treasury prints bonds and they borrow lots of money, and then the Fed buys those bonds directly or indirectly. In the case of the United States, the Fed is banned from directly buying the bonds from the Treasury. So what we worry about, though, is that what if the Fed is indirectly doing it? What if they're just using it like the Treasury, and the Treasury takes the money from a bank, and the bank gets the money from the Fed, right? So in effect, there's concerns that if the Fed is constantly buying bonds from banks and the banks are just turning that money right over to the Treasury, that really you're just monetizing the debt. And so that's a fear. And other countries have accused the United States of doing things like that as well. I don't think we do. Most central bankers would not say that that's what we're doing, and most economists I don't think would agree with that. Second would be is that some tools have become less effective, and in particular, the discount rate, the reserve ratio have become less effective. And we also would say that there's issues with open market operations as well. One of the issues is actually the problem of you can only go so low of a zero bound for interest rates. And this is the idea that it's hard for the Fed to push interest rates negative. Now, the European Central Bank pushed interest rates negative in the 2008 crisis, and they've experimented with it since then. It's not as effective as maybe we would hope, and maybe some people wouldn't hope. But realistically, the Fed has pushed up against the 0% interest rate line. But once you're below that, you're in uncharted territory. There's the possibility that if you overuse it, you could have hyperinflation, right? If you're constantly increasing the money supply and you're just doing it to try to help the government and help the economy, that maybe you run the risk of too high of inflation. And then a fourth issue is that even with an independent central bank like the United States, you get pressure from fiscal policymakers. And this is the kind of thing where if Donald Trump tweets about how the Fed should cut interest rates, that's pressure, right? And we worry about that kind of thing as economists because we want the Fed to be independent. Right, so I'm going to put that here. Want the central bank to be independent, so that they can make their decisions without fear of basically of retribution. So now a couple of long-run concepts here about money and prices, and this is the story that might be useful to understand here. First is that if the Fed increases the supply of money, we know the interest rate should drop, and that will increase consumption and investment and aggregate demand. But then we also know that's higher prices, right? Higher price levels, and that leads to higher inflationary expectations, which can reduce aggregate supply. We also know that those higher prices lead to more demand for money and push the interest rate back up again. And so this is the idea at root of what we call money neutrality. And I have it typed as well below this, but it's the idea that the money is neutral in terms of output and in terms of interest rates, that really you can't change output very much because this higher aggregate demand will just create more inflation, and that'll bring aggregate supply right back to the full employment, right? You can't change full employment. And likewise, you also can't change interest rates because they're going to come right back up as well. So there is an argument that you can't affect output or interest rates, but you can push prices higher, which is hyperinflation. Now, there's one exception to this, and you're going to see this a lot in questions, and it's this. If the supply of money goes up, let's say the Fed buys bonds, makes the money supply bigger, and the real interest rate goes down, and we push more investment, then there's more capital goods and more productive capacity. I want you to really put a star next to that because that can increase growth. And now we've seen questions on exams about this before, but here it is spelled out for you. This is a really important link because if you see a question that says, what's this impact of interest rates on growth, right? What's the impact of a change in real interest rates on growth? You can see here, if there's a lower real interest rate, it can lead to higher growth through more productive capacity. So hopefully this annotated notes set has helped you a little bit in big picture thinking about fiscal and monetary policy. I'll see you next time.